Hi guys, today I'd like to talk to you about what happened in the past couple of weeks in the stock market and in the world in general. And also at the end of the video, I'd like to give you one stock that I think is a good investment right now. So as always, like this video, subscribe, and if you want to join my Patreon club, the link is in the description. Well, it's been a very tough trading environment in the past couple of weeks and solid shoes in the past couple of months. And that's all because of the inflation, war going on between Russia and Ukraine, and supply issues, COVID lockdowns in China, and overall the environment hasn't been good. So that brings a lot of pressure on stocks and bonds because Fed's attempt to fight inflation by raising interest rates. And last week, James Bullard, who is the voting member of the St. Louis Fed, came out and said that maybe in their main meeting they may raise rates by 75 basis points, which took market by surprise, and it was a big sell-off on Thursday and Friday just based on those comments. Fed projected, and specifically Jerome Powell, that they will raise rates this year at least 7 times. Then it was upgraded to 8 times, then 9 times, and now they're talking about 10 times, which is a lot of pressure for the market. And people start to sell bonds when Fed raises rates. And when people sell bonds, obviously the 10-year treasury rates rise, which is 10-year treasury yields. And that makes debt very expensive. And that hits a lot of companies that borrow money. Specifically, most of them are tech companies. And that could actually hit their earnings. So last week, 10-year treasury rates came close to 3%, which is a big psychological level, because when it comes to 3% on 10-year treasury, investors just start selling bond stocks, and regardless of their quality. It's just a big psychological level for some reason. I don't know why. But in general, it's been noticed that a lot of institutional investors have zero exposure to equities, which is good news and bad news, because the good news is that any good news could bring those investors back, but the bad news is it's been a buyer strike pretty much, and nobody knows when those buyers will come back. And they're just sitting on the sidelines, sitting on a lot of cash, but they're not coming back until the inflation is under control and the current Fed's raising cycle is over. And once they see that, they will come back into the market. But for now, they are not coming back into the market. When that's going to happen, nobody knows. But I'm thinking that we'll have some clarity after May's and June's Fed meeting. And once Fed is more comfortable with current inflationary environment, and once they say that it's enough, then those institutional investors start to come back into the market, and that's when maybe it's time to go back in. But for now, it's a very difficult environment considering those factors. Also, the war in Ukraine. That creates even more inflationary environment, because prices for oil and natural gas and steel and aluminum and other commodities are very high, and that actually fuels the inflation. Also, a lot of people ask me about war in Ukraine, because I originally came from Ukraine like 30 something years ago, but I still have friends in Ukraine, and I have some insider information of what's going on in Ukraine right now. I mean, it's terrible. But at this point, from what I can see, Russia lost the battle for Kiev, and they retreated to like Donbass region, and there's a big battle for Donbass is happening right now. But from what I can see, from what I can read, alternative channels, not only American channels, that Ukrainians are very well prepared for this battle, even though they have a smaller army, but they're constantly supplied by weapons from the West, and specifically from the United States. And by the way, the United States um, just accepted the Lend-Lease, so they will lend weapons to Ukrainians, any weapons like heavy weapons, tanks, or airplanes, and other things, without with no regard for money at this point, and Ukrainians will pay later. But very courageous fight by Ukrainians, and I actually think that they have a very good chance to win. But in terms of the market, the stock market, a lot of investors are actually scared by Ukrainians winning because they're afraid that Putin can actually go for nuclear weapon strike. And many people are not only concerned about the inflation at this point, but also the nuclear war that may happen if the Ukrainians start winning and Putin is like put in a corner because of that. So that's what's hanging over the market, and until those things are cleared, the market will be in a in a state where it can go up, but it really cannot go much down. But I think it will be trending down, and for a while, at least for a bit, until we have a clear situation with the war, with the inflation, and other things. So at this point, I would stay on the sidelines. And if you have a more professional view on the market, maybe short couple of things like sell the rallies, but I would not buy many things until the war and like I said, the inflation picture is clearer. But sometimes big sell-offs bring big opportunities. And today I'd like to talk to you about one stock that I think has a really good chance to come back in the current environment, and I think it's working in this environment. So let's see. The stock is Upstart. One of my favorite companies operates as a AI lending platform in US. What it does is it aggregates consumer demand for loans and connects it to its network of the company's AI-enabled bank partners. In other words, its AI lending platform partners with banks and credit unions to provide consumer loans using non-traditional variables such as education, employment, and to predict its credit worthiness. I think they have like 1,600 variables that they use to do so. And it burst into the market at the end of 2020 with the initial public offering priced at $20 per share. Then it peaked at $401 a share less than a year later. And since then, though, it's been a downhill, and the stock trades for under $80 per share today. So it's been rough going for Upstart shareholders for now. But I mean, there are good and bad. If we talk about the future of the company, because good, I think the company could work well in the current rates raising environment. Since if rates go up, that means consumer loans become more expensive, and people will be searching for more alternatives, and that's where a company like Upstart could bring a tremendous value for their partners and for the consumers as well. At the same time, with the current macroeconomic headwinds, lending money becomes a riskier proposition, meaning banks will be more cautious about to whom they lend money and may start cutting back on loans. But banks don't make any money by sitting on their deposits. They need to loan money to consumers if they want to generate profits. And Upstart AI-driven system reduces the risk for banks. So currently it's trading at 30 times forward PE right now, and I think it's a good stock to start accumulating at these prices, as I think it may be very, very rewarding for a long-term shareholder. So as you can see, it hit this level, $75 level, a couple of times. I consider this as a double bottom. Sure, it can go lower, but I think it's a pretty good level, like I said, to start accumulate shares in this company. And the reward could be quite large. considering what they can do and where they can go. So that's it, guys. That's my company for the day. And again, don't forget to subscribe to my channel. Click the like button. Join my Patreon club, and I'll see you next time.